Since Thursday, Bank of America has raised billions in capital, regained $14 billion in market value. Now, it all started when Warren Buffett agreed to invest $5 billion in the company. Yesterday, the company, BofA, agreeing to sell half of its stake in China Construction Bank. That gave it a profit of $3.3 billion. Joining us now with his view on Bank of America is Brian Charles of RW Pressprich. Bloomberg has crunched the numbers, and Brian is one of the most accurate analysts on Bank of America. It makes him a Bloomberg best. Brian, thanks for coming back and talking to us about a little bit in more detail on Bank of America and this idea of selling Chinese assets. There's so much happening in this stock in the past 2 weeks. You and I spoke earlier in the week about Warren Buffett's investment. Is this selling of the Chinese assets a way to try to strengthen its books, and we should read some danger signs in there, or is just business as usual and they're just trying to agree with capital requirements as per Basel?
That's right. It's business as usual as far as bringing their capitalization into terms with Basel III requirements. They've already owned China Construction Bank, and they held it as a gain on their balance sheet, but this is just a way to realize that gain. Before it was an unrealized gain, now it's a realized gain.
So there's zero surprise in this for you?
No, they were anticipating selling at least a stake. There was some speculation they would just sell the entire stake as they were trying to talk about bringing themselves into Basel III requirements. But the fact is, under Basel III, they wouldn't have to sell the entire stake, so they decided not to.
It's also got to be tough to get rid of a stake that big, right? I mean, we're talking about $8.5 billion for half of it. We don't know yet who the investors are, but I mean, it's not easy to move that size a stake.
No, I think it was it's some period of negotiation. I'm not sure exactly how long, but I know there was speculation a few weeks ago that they were marketing at least half the stake.
What about the speed, though, with which these news items? I mean, Bank of America is the hottest story in the market, right? The last few weeks, it's been amazing. Warren Buffett comes in and does something he only did with Salomon Brothers way back in the heyday, and then Goldman Sachs.
Right.
Now we have the China Construction Bank sale. I mean, these things have definitely been brought on, haven't they, by the incredible decline in Bank of America's stock?
That's right. I've had this the thesis that they don't have to raise capital, so I was a little surprised to hear that they had raised capital with Warren Buffett. But the terms of the deal and what was happening to the stock, even if they didn't have to raise capital, I can sort of see the objective behind it. You know, it certainly helped the stock. It's a great deal for Warren Buffett, but that doesn't make it a bad deal for Bank of America by any terms.
Brian, our colleague John Ehrlichman was just sitting right here with us telling us that now Bank of America is in the hot seat with the FDIC, and this $8 billion, $8.5 is not enough, perhaps, for the banking regulator. What does this mean for the stock? Because you have a speculative buy on it.
That's right. I think right now I'm estimating that the deal will be approved in some form, but I can't rule out the possibility it might be higher than $8.5 billion. But as far as the FDIC's filing is concerned, really they're just filing to get involved with the process. They don't have enough information to decide whether or not they want to go along with it.
So they're just throwing their hat in the ring, saying we just want to be present.
Right. And actually, according to the terms of the agreement, there is a period in which anyone who would be involved or has associated securities could file to get involved with the process to decide exactly how they came up with $8.5 billion.
What's the biggest sort of headwind, overhang / risk for Bank of America? I mean, is it the litigation that's the biggest problem? Is it their mortgage exposure?
Yeah, what part of your buy, the speculative buy, is
what
speculative?
What makes it the most speculative?
That's a great question. It is the litigation risk, the mortgage overhang associated with that. Because if I were to take that off of the income statement and remove all the associated expenses, this is a stock that I think could be earning about $2 a share this year. Maybe
you wouldn't even cover it in that case.
It might even be out of my range. It's I'm basically focusing on special situations, and this wouldn't be this wouldn't be unique in that circumstance. So
at what price do you tell people then just stay away?
Well, in this market, if they were earning close to $2 a share, and where normal multiples were about 10 times, now I think they're about 7 or 8 times. I guess if it gets up to the $14 or $15 range, I might see some less potential for outperformance in the short term.
Brian,
probably the way to say it.
That's a good way to say it. Thank you very much, Brian Charles, joining us. He is an analyst with Pressprich and Company. He is a Bloomberg best on Bank of America.